Banking and credit scores, the foundation of financial literacy, right there. Level 1, ground floor. Now, regardless of whether you ever learn about stocks or bonds or real estate or crypto, you should definitely learn about banks and credit. Why? Well, when it comes to money, if there's one thing that most of us use because it makes life easier, it's a bank. Spoiler alert. And if there's one thing that many of us use simply because we're forced to, it's a credit score. Spoiler alert. So let's delve into the basics of how all this works. And let's start off by talking about banking. Now, most of you know banks as that place you go and store your money so that you can get it whenever you want. Kind of like a big sock drawer that comes with an ATM card. But have you ever wondered why banks hold your money and how exactly they make a profit? I mean, banks are often thought of as simply this place, this giant shoebox, this massive piggy bank where people go and put their cash until they want to get it at a later date. But despite roughly 90% of Americans and roughly 70% of the entire world using the banking system, many don't completely understand how it actually works. So, let's start off by clarifying how exactly banks work. When people have placed their money into a bank, they're not simply putting money into a storage unit. They're actually lending their money to the bank. And this is why bank accounts pay interest. It's not because the banks are nice, but because they want to offer people an incentive to lend them their money. So why do banks want your money? Because banks want to use your money to lend it to other people. I know what you're thinking. Oh, hell no.
No, 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 no. Hell no. 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 I refuse. No. No.
But it's true. They take other people's money and lend it to those who wish to borrow money. And the interest they charge people for borrowing the money is significantly higher than the interest they pay on bank accounts. Thus, the banks are making a lot more money from your money than you are. Right? They make a lot more money from the borrowers taking out the loans than they're paying you to lend them your money. Even though technically you and everybody else with a bank card are actually the lenders.
Say what?
To simplify, banks will borrow your money for a small amount of cash and then lend that money to someone else in exchange for a large amount of cash. I mean, they make much of their money simply from being the middleman. For example, to keep things really simple, let's imagine Cartoon Bank opens up and they pay 25 cents every month to anybody who owns a bank account with at least $100 in it. So Big Bird, Mickey Mouse, Dora the Explorer, they all get together and they decide to open bank accounts. Each of them puts in $100. Now, the Cartoon Bank has $300 in it. 100 from each of those people. Now, Cartoon Bank promises each of them that it will pay them 25 cents for every month that they keep $100 in their bank account. This would be what we call interest. That means if each person keeps their $100 in the bank all year for the whole 12 months, then they will have $103 at the end of the 12 months. They will have earned $3, which is 25 cents per month for the entire year, by doing nothing more than simply lending the bank money that they're not using right now. They're granted $3 for doing nothing other than placing it in a secure location. Now, $3 doesn't sound like a lot, but still, you're getting it for doing nothing. You're just putting your money someplace. You're lending it to the bank. You're letting them hold it. And in all actuality, they're providing security. So you're getting security and you're getting bonus money just for lending them your cash. If the bank did nothing all year but hold these 3 people's money, they would hypothetically lose $9 because it would have to pay each of them their $100 back, in addition to the $3 that they promised each of them.
So, on paper, it sounds like banks are setting themselves up for debt. But why would banks do that? Well, banks aren't run by morons. Usually. So they must have a reason that they're willing to pay people this interest, this extra money, just so that they can hold on to other people's cash. But what is it? What could it possibly be? Why would the bank want to pay people extra money just so that the bank can take on the responsibility of holding their money? I mean, that sounds rather silly, doesn't it? I mean, imagine someone came up to you and said, "Hey, can I pay you to hold and protect your money? And you can have it back anytime. I'll keep it completely safe, and I'm going to pay you a fee just for the privilege of letting me hold your money?" Now, assuming that you knew that they weren't shady, assuming that you knew that they could be trusted, assuming that you knew that they hadn't been snorting the funny stuff, wouldn't your response be, "Heck yeah, hold it all, just pay me"? But why? Why would a bank offer to do that?
Well, the bank would offer to do that because the bank is going to take those characters' $300. This is Mickey's and Dora's and Big Bird's money, but they're going to take that money that they're holding because it's in their possession right now, and they're going to put it to use. So let's imagine that Homer Simpson comes in and he needs to borrow money. And despite the crumbs on his shirt, the bank agrees to lend Homer $300 as long as he pays them back $300 by the end of the year with an additional 20% added on. That means that after 12 months, Homer will owe them $360. That $300 that he borrowed from them, plus the 20% interest he promised to give them, which would be an extra $60. So let's say after a year, everybody settles up. Homer pays all the money back, and all the characters come in to take their money and close their bank accounts. The bank has $360 total. They pay Big Bird his $100 back, and they give him his $3 interest. They do the same for Mickey Mouse, $100 and $3 interest, and they do the same for Dora. Here's your $100 back, and here's the $3 interest. Thank you very much. The bank has now paid out $309, which leaves them with $51 left to keep for themselves. They made $51 by simply lending other people's money. The bank never had a dime in this to begin with. Now, the lenders aren't too upset because they've made extra money, albeit not as much as the bank did, but technically everybody wins. Homer got to borrow money that he needed at the time. The lenders got to keep their money in the bank with security and earned a little something extra for doing it.
It's days like this that make me happy to be a bird.
And the bank made itself a nice profit by working as the middleman. This is essentially how banks work. So, beyond paying interest,
let's clarify what banks have to offer people. Like, why do people keep their money in the bank? Well, first and foremost, like I said, one reason is safety. I mean, if you had to walk around with every dime you owned at all times, would you be comfortable? Probably not, because should something happen, should you drop your wallet, you lose your bag, you get pickpocketed, you're in deep trouble, right? There's no security protecting you. You could lose everything you have in a moment. And even if you keep all your money in your house, there's still danger. Your home could get robbed. Your nanny might have the sticky fingers, you know what I'm saying?
Just a spoonful of
your savings helps my bills go down
in a most delightful way.
I mean, heck, there could be a fire, and burnt money is useless. So Holding on to your savings carries a lot of risk. This risk is eliminated when you keep your money in a bank.
People like that they don't need to worry about misplacing their money or having it stolen. And even if something does happen to the bank itself, I mean, who knows? Maybe a bunch of nostalgia cowboys run in and rob the bank, completely clearing it out, like they were living some sort of Billy the Kid fantasy. Wait, what? No. I said bank robbing cowboys, not backup dancers for Lil Nas X. You're all very talented, but you gotta go. Sorry. Okay, thank you. Ridiculous. Now, as I was saying, if the bank gets robbed, doesn't really matter. Because usually banks, for example, the ones in America, are insured. The ones in the US are insured by the FDIC. So as long as you put your money in an FDIC insured bank, which is most of them, your bank account is insured for up to $250,000, which means no matter what, if you put $250,000 in the bank or less, you are guaranteed to get your money back, no problem. Don't worry about it. Keeping your money in a box at the back of the closet would make a lot of people feel uneasy, so the security alone is a good reason for why many people keep their savings in a bank. Another reason people do it is accessibility. You see, most bank accounts nowadays offer ATM access. They'll issue you a bank card, and you can use this card to withdraw money from ATMs all across the world. I mean, this is incredibly convenient for people because it means that they are only as far away from their money as they are from an ATM. And if you've ever been out at the store and realized, you don't have enough money to pay for something, I'm sure you can attest to how much more convenient it is to simply pop your card into a machine so you can get the cash you need, instead of having to go all the way home to grab cash from your hidden box at the back of the closet that your family knows about and your cat seems obsessed with.
Meow. I know where you're hiding your money. So if you want me to keep it a secret, it's gonna cost you 5 cans of tuna. Meow.
Plus, most bank cards double as debit cards nowadays, which makes everything even more convenient. I mean, debit cards act as cash without having to actually take cash. You don't have to take the risk of carrying around your actual money. All you do is swipe your card like you would a credit card and voila! The money is withdrawn from your account and given to the store where you made your purchase. Plus, nowadays there are even apps that act as debit, like Google Pay, Apple Pay, WeChat, depending on what country you're in, of course. So all you need to do is scan your app. You don't even need the card, which makes it even more convenient. And most stores accept debit nowadays, which means you could very well go shopping without having a dime on you, and that is pretty convenient. And of course, if you wanted another reason, there's always the interest that you earn for keeping your money in the bank. Interest is the money the bank will pay you to allow them to hold your money. This is usually expressed through an APY, or annual percentage yield. The APY is a percentage of your money that the bank will pay you in order to keep it in the bank for a year, thus the word annual. For example, an APY of 2% means you'll earn 2% of your money if you keep it in the bank for a year. And this 2% is broken into 12 payments, so each month you'll earn 1/12 of whatever the APY is that you've been promised. So you don't have to keep your money in the bank for the entire year in order to earn interest. You just got to keep it in the bank for the entire year to earn the full interest, the full 2% in this case. In other words, if your bank offered you 12% APY, and it most certainly will not offer you anything that high, but if it did, then you'd earn about 1% per month, 12% over the course of a year. So what kind of accounts can you actually open at your bank? Well, first off, you have your checking account. Checks, of course, refer to those rectangular slips of paper that were used to make payments back in your great-great-great-great-great-great-great-great-great-great-great-great-grandpa's day. Now, of course, we still use checks nowadays as well, but most payments are done electronically because we use computer systems.
Hey, Johnny, I hear you did well in school. I'm gonna give you a check, and you can use it to go buy yourself some candy and soda pop.
Great, that's cool, Grandpa. Hey, listen, instead of giving me a check, how about you check for some cash instead? Because that'd be much cooler. Thanks, Gramps.
A checking account gives you easy access to your money through various methods, including a checkbook, debit card, and ATM access. In general, people keep their money in these accounts so that they can easily make payments and purchases without having to worry about losing money or misplacing it or being robbed. This is where you put the money that you plan on spending. Now, when it comes to checking accounts, you do have some options. You can open a basic checking account. You can open an interest-bearing checking account. Your basic checking account is also known as a no-frills account. It may limit the amount of transactions you can make per month. Usually it doesn't pay interest. Some banks might even charge you a fee for opening it. They may also charge you a monthly fee as well if your balance is under a certain minimum. Now, these fees are usually under $10, but still, a fee is a fee. Now, many banks do waive the fees for people, especially those who deposit a minimum amount of money into the account, just as long as they don't dip below that minimum amount of money. For example, your bank may charge $5 monthly to maintain your account, which means you'd have to pay them $5 per month to keep your account open, but they may not charge you that $5 if you keep, let's say, at least $100 in the bank account. Why? Because it gives people incentive to keep more money in the bank. And the more money the bank has, the more money the bank can loan. I mean, if everybody just kept $1 in the bank, then it would probably cost the bank money, seeing that they do have expenses. I mean, the people that they hire, marketing, rent on their locations, all that stuff. I mean, some of the fees they charge just go to their overhead, so the bank can at least break even. But trust me when I tell you, banks more than break even usually, especially the big ones. Now, as I said, there are also interest-bearing checking accounts, and these are sometimes referred to as negotiable order of withdrawal accounts, or NOW accounts for short. Although they do pay interest, they often have higher fees than basic checking accounts, and if you fall below your monthly minimum, tisk tisk tisk, some banks are going to charge you a significant penalty. Now, how much interest they're willing to pay you can vary, and it may depend on how much money you are actually putting into your account. So it's best to shop around, because every bank is different, and find the best deal for yourself given the amount of money that you plan on putting into your checking account. Let's move on and talk about savings accounts now. As the name suggests, a savings account is where people keep their money that they're looking to save and put away for later. Savings accounts basically give people a place to store their money and build up their fortune, or their nest egg, for people who like bird metaphors. Now, much like checking accounts, people can enjoy the safety and the convenience that a checking account offers. However, savings accounts tend to offer higher interest rates than checking accounts do because they're designed to hold large amounts of money for longer periods of time. Again, keyword there being saving. I mean, ideally, you're not really supposed to spend the money from your savings account. It's supposed to remain there and grow. It's supposed to be saved. Now, much like with checking accounts, savings accounts also have many different options. First off, you have your basic savings account. This is your simple savings account, just designed to hold and secure your savings. They tend to have moderate balance requirements. So you usually do have to keep a minimum amount of money in the account. Otherwise, of course, they'll charge you, but usually the minimum requirement isn't too high. Plus, most banks allow their customers to connect their savings account to their checking account, so they can easily make transfers back and forth whenever they need to. Your basic savings account usually pays interest, although the interest rates on a savings account do tend to be pretty low. After all, banks aren't trying to pay you too much, right? Now, depending on the country you open your account in, the interest rate will differ. In countries like the US and the UK, interest rates tend to be incredibly low, with the US offering on average 0.06%. That's 0.06 of 1%. And the UK averaging a bit better with roughly 0.2%, which is 0.2 of 1%. Very low. Ain't nobody getting rich off that. The reason banks and countries like this pay so little is because they typically do not need to attract new customers. Over 90% of the population in these countries have bank accounts, so they don't need much persuading. Although, it should be noted that many online-based banks tend to offer higher interest rates because they do want to attract more customers as they are less established, and they also tend to have less overhead since they're primarily based online, and they don't need to pay so much for employees and locations, etc. You may notice that other countries tend to offer significantly higher interest rates, some as high as 10 or 20%. And no, that's not 0.10 or 0.20. I'm talking 10 or 20%. But this is typically for two primary reasons. One, they tend to be less established countries, many of which are in Africa or South America, which also tend to have higher risks of default, political instability, and less banking regulations. So there's a lot more risk that comes with putting your money in those bank accounts. And two, inflation may be much higher in these countries. So if a bank account is paying you 10%, but inflation is 9%, then your interest really only works out to be 1%. So while different countries do allow foreigners to open bank accounts, if that's something you're interested in, do your due diligence and don't just look at the percentage paid on the account alone. Then you have your money market account. Money market! If only it really was a market that gave you money. Alas, that's not what it is.
False advertising.
Money market accounts tend to require a higher minimum balance, but they also do tend to pay a higher interest. They also tend to allow check writing. So in that capacity, they're kind of like a savings and checking hybrid. So basically, if a savings account and a checking account crossbred and created a new mutant account, it would be a money market account. But you do have limits on the amount of times that you can withdraw money from your account. Then you have CDs. CDs bank accounts? No, they have nothing to do with the circular UFO-shaped things that people used to use to listen to music back when life was in black and white. CD is short for Certificate of Deposit. CD accounts are savings accounts that prevent you from accessing your money for a certain period of time, which can range from 1 month to a year or even longer. The longer the time, the higher the interest rate. Now, why does the bank want you to put money in the account and promise not to touch it? Why are they going to give you higher interest rates just for doing that? Because if you put your money into an account and you promise not to touch it, the bank can guarantee that that money will be there. It's going to be in their system for at least that amount of time. So they can loan it or whatever they need to do because they know that it is guaranteed, and that is why interest rates tend to be higher than your basic savings accounts, which allow you to withdraw your money at any time you want to withdraw it. Now, that doesn't mean if you put your money into a CD, it's locked away in some prison of Azkaban. If you needed to withdraw your money from a CD account before the time period expires, you could do it, but you'd have to pay a fee. The date that you're technically allowed to access your money is called the maturity date. So if you put your money into a CD account for 1 year, then your maturity date will be 1 year from the day you open the account. So again, the maturity date may be 1 month, 6 months, a year, whatever it may be, whatever the agreed upon time is. If you withdraw your money early, expect to pay a pretty high penalty fee. I mean, you're essentially breaking a promise of sorts. You agree to put the money into the CD because you're not going to touch it. And if you touch it, I mean, it's your money, you can. They can't prevent you from doing it, but they're going to charge you for it to discourage you, or perhaps penalize you, for doing it.
So, to summarize, if the bank were a man, and that man happened to be a superhero, then the bank would be Captain Lazy Slob. Not because the bank is a lazy slob itself. As we've established, the bank actually gets quite a bit of exercise lending other people's money all day. The bank would be Captain Lazy Slob because he would be an advocate, the hero to millions of people, like myself, who just don't want to be bothered hiding our money in a briefcase like we're involved in some sort of hostage situation, or in a treasure chest like it's One-Eyed Willie's gold. I mean, nowadays, in a lot of countries, having a bank account is almost necessary just to get paid. In the US, for example, it's common for companies to directly deposit payments into their employees' bank accounts. Now, of course, They could give a check, but without a checking account, the person would then usually have to pay a percentage of that money to a check cashing place to cash it for them. So there's lost money. And if you work at a place that does pay cash, well, then you have to worry about carting around a bunch of cash in your pocket. And I don't care how safe your neighborhood is. If you're walking around with a wad of cash in your pocket, you are one dude in a ski mask away from having your hard-earned money jacked, like you were some sort of nerd holding milk money. And ain't nobody want that.
So maybe you're sitting there and you're saying, wait a minute. If I'm lending the bank my money, why do I have to pay them fees? Well, it's because they're greedy monsters, but also because for a bank to succeed, it's only worthwhile for them if you lend them a certain amount of money. These are what are called the balance minimums. This is the minimum amount you must keep in your account in order to avoid paying fees. A bank will set up a certain limit amount. That is your balance minimum. And if you keep that much money in your account and you do not dip below it, usually they're not going to charge you a fee, they'll leave you alone. But if your account is lower than the minimum, it's actually going to cost you. Because it's actually going to cost the bank to hold your money. After all, again, they have to pay the employees to manage people's accounts. And that may not be worthwhile if these accounts only have a few dollars in them. So the banks determine what the minimum amount of money is to make sure it's worthwhile.
What exactly is a credit score? Well, let's clarify. A credit score is a number that's given to you and everybody else that helps lenders, banks usually, determine how risky it is to lend you money. In other words, it determines your credit worthiness. Imagine all your friends secretly got together and discussed whether or not they would be comfortable lending you money. Well, the credit score is kind of like the professional version of that. Only instead of being nice about it and saying, oh, I don't know, I have a lot of college debt, rent is due, Netflix just tripled in price. I want to lend you money, I just don't know if I can afford it. Like your friends that don't want to lend you money might say, just to kind of save your feelings. The credit score doesn't care about how you feel. It's going to be straight up and it's going to give you your trustworthiness value. That is your credit score. Your credit score is important because it's kind of like a merit badge. It's a badge that shows that you're responsible. Good credit scores suggest that you're good with money. Good job, buddy. Now, having a good credit score makes it much easier to take out loans, especially for big purchases like buying a home, buying a car, borrowing money to start a business, or to build that awesome pinball obstacle course in the backyard that you've always wanted. Whatevs. So, moral of the story is we all want a good credit score, but that raises another question. What exactly determines what your credit score is?
A credit score is determined based upon many factors, including the amount of money you currently owe. Those are called your debts. So that could be money that you owe on your credit card. It could be money that you owe on previous loans. It could be late bills, money you owe to companies. Any outstanding debt or money owed will be a factor. But they're not going to just look at what you owe. They're going to look at your previous borrowing history. So they're going to check for other times you borrowed money, other times you used credit cards. It's like a full medical check, only they're checking for the health of your credit. And yes, it does involve a full cavity search. Metaphorically speaking, of course. Basically, they're looking to see if you've paid your debts back. And if you have, good for you. And if you pay your bills on time and you don't owe companies any money, good for you. That works to your advantage. So, late is bad, owing money is bad, making payments on time is good, not owing money is good. So, how much credit you're currently trusted with may be based on how many late payments you've made, hopefully none, and how much money you owe. But also, they could factor in how long you've actually been using credit. How long have people been trusting you to pay them back? Having a high credit limit, which means that you're trusted to borrow a lot of money, helps increase your credit score, so someone that's trusted with a $10,000 credit limit is seen as being more trustworthy than someone who could only get a $200 credit limit. The reason that not having outstanding debts, and I'm talking about not owing anybody anything, the reason that not making late payments, and even the reason that having a long history of credit work to your advantage is because it shows responsibility. That's the whole idea behind the credit score. It's a reflection, or at least it's supposed to be, of how responsible with money you are. Now, obviously, paying your bills on time and not owing any money are clear signs that you're responsible with money. But why does the length of your credit account matter? Well, because it establishes a pattern. If you've had credit for 6 months and you don't owe any money, hey, that's cool, bruh. But if you've had credit for 10 years, that's far more impressive, especially if you don't owe any money, and it gives a lengthier track record to check your behaviors. Because if you had a credit card for 5 years and you pay it off on time every month and you don't owe too much money on it, not only are you showing that you're being responsible, but you're showing that you're being responsible over a lengthy period of time. You've had 5 years of responsibility to back up how trustworthy you are. If you have a credit card for 2 months, even if you've paid it all off on time, you don't owe any money, you've still only shown that you can be responsible for 2 months. So, people who have longer track records of credit tend to be a little bit more trustworthy. Now, you might be sitting there thinking, well, I've never borrowed money from anybody, and I don't owe nobody nothing. So my credit score must be through the roof, high as the sky. Well, not quite there, Kimosabi. No, it doesn't mean that at all. Doesn't mean you're trustworthy. Doesn't mean your credit score is through the roof. What it means is that you don't have a credit score. Oh, the irony.
What's going on with you? What are you talking about?
It's true. Ironically, not borrowing money works against you. Now, it might seem counterintuitive to go out of your way to borrow money that you don't need just to show people that you can borrow money that you might need, but that's the way credit is set up.
Oh no, it's a trap.
In order for institutions to lend you money, they have to know how much to trust you. After all, asking a bank or some other credit agency for a loan is not much different than asking a total stranger for one. I think they need to know how trustworthy you are, and credit scores are one of the most important factors they use to determine this. So, what this means is that you have to establish credit to have a good credit score, and not having a credit score is not interpreted as a positive. It's more a negative because it means your trustworthiness is unproven. It doesn't mean that you're not trustworthy. It just means that nobody knows if you're trustworthy or not. This is like your friend coming up to you and saying, "Hey, I need you to borrow my car." And you say, "What? I don't need to borrow your car. I got my own car, and a motorcycle, and a bicycle, and a skateboard, and a couple of roller skates, but don't tell anybody. I don't need to borrow your car." And then your friend says, No. You need to borrow my car." And you say, "Why? Why do I need to borrow your car?" And he says, "Well, you need to borrow my car so you can prove that I can trust you to borrow my car in case you ever want to borrow my car." And you might say, "What the hell are you talking about, man? Who's talking about borrowing your car?" And he would say, "Listen, if you don't borrow my car and prove that you can borrow my car, then nobody's going to trust you to borrow anything. Now, unless you want to be known as the person who can't be trusted to borrow anything, I think it's in your best interest to borrow my car." And you would say, "Ugh, fine, just give me your stupid keys. Let's get this over with." Now be careful. Just because credit scores are determined by credit usage, that does not mean you should run out and start using a bunch of credit cards. It's very important not to misuse the credit that you've been given, because doing that will negatively impact your credit score. And having bad credit is much worse than not having a credit score at all. So if you feel like you need to start establishing good credit, it's generally recommended that first off, you pay all your bills on time, and second off, if you decide to use a credit card, which is one way a lot of people start to establish their credit, it's highly advised that you use it as a charge card. In other words, you pay off the debt in full every month. This will prohibit you from getting charged these hefty fees that are associated with using credit cards, but it will work to establish your trustworthiness because you use the credit, but you pay it back on time every month. Plus, if you pay it off in full, you won't be in debt. Then, of course, slowly over time, you establish that you've been doing it over the course of many years, and your credit score will continue to climb higher and higher. Now, of course, if you don't plan on ever using credit, then the credit score typically won't mean much to you. Sure, there may be instances where people run a credit check on you. For example, some landlords run credit checks on tenants that they plan on renting their homes to. But generally, people in this position are looking for outstanding debts. They just want to make sure they'll be paid on time. So while not having a credit history may initially work to your disadvantage in a case like that, you can simply explain that you generally don't take on debt, you pay your bills on time using actual cash, and you don't borrow, which should, theoretically, hopefully help establish your responsibility in a different way.
So the next question to ask is who? Who exactly determines the credit score? Who are these credit demons, these sneaks, these faux Santas that know if we've been naughty or nice with our money? Who are these soothsayers of savings, these Merlins of money, these monsters of mayhem? Who are these werewolves of London, these housewives of Atlanta? I think I've lost the script. What the hell was I talking about? Oh, right, yeah, okay. Who determines our credit score? That's right.
Well, different countries may use different credit reporting agencies, but there are 3 companies that are the most prevalent globally. And they use different but similar formula to determine what people's credit scores are. These companies are Experian, TransUnion, and Equifax. They have access to your credit history, which tells them what you've borrowed, what you owe, how much money's in your accounts, what payments you've made, if any of those payments have been late. I mean, they take all that information and they apply their own little mathematical formula to it, and they offer a credit report based on the results. Now, although the number on your credit report will usually be different from each company, all three numbers generally tend to be within a few points of one another. They all tend to be in the same ballpark. Now, while Experian, TransUnion, and Equifax are credit reporting agencies, there are also credit scoring agencies, the most popular of which is FICO and its major competitor, VantageScore, which has been increasing in popularity over the last few years. Now, they take the information from each of your credit reports and they apply their own mathematical formula to them, and the results are your credit score. So, because there are three different reports and each of those reports may contain different information, you often end up with three different credit scores, one based on TransUnion, one based on Experian, and one based on Equifax, even though they're usually within the ballpark of each other. To clarify a bit about the difference between FICO, VantageScore, and the three credit reporting agencies, or as I like to call them, the singing sirens of the sea, for you mythology fans out there. Of course, in this case, the sea wouldn't be referring to the body of water, it would be referring to the first letter of the word credit, which also happens to be the first letter of the word cash, and criminal, and cabbage. Not necessarily any relation there. FICO created a formula to calculate people's credit worthiness, which again we call the credit score. It makes money by leasing this formula to the credit agencies. Credit agencies collect information about people and then apply this formula to their information, and then they end up with their score. They make money every time a bank or agency or an individual orders their credit score. The agencies, however, got sick of paying FICO, so they got together and created their own formula and called it VantageScore, which became the competitor to FICO. So this was the three agencies' way of trying to cut FICO out, like some sort of mafia movie double cross. But banks weren't having it because guess what? FICO is an OG and they trust it. It works for them. So lots of lending agencies stuck with the FICO formula, and thus we now have FICO and VantageScore. The credit agencies, of course, push banks to use VantageScore because they own it, but they do have to oblige when FICO is requested, which is most of the time. Thus, that explains why FICO and VantageScore numbers may be different. They use different formula for the same information. So to summarize, Experian, TransUnion, and Equifax are credit reporting agencies. What they do is go get all of your information, your banking information, your credit information, and they report that information. FICO and VantageScore use that information to determine your score. Now, if you order a report from Equifax or TransUnion or Experian, you're also going to have your credit score for that individual company. But FICO and VantageScore give you a credit score based upon the information collected from all three companies. One caveat. FICO and VantageScore are always changing their formula to better assess credit worthiness based upon the feedback that they get from lenders. Again, the whole point of this is for people to determine how trustworthy someone is with money. So, the lenders will give suggestions on how to tweak the numbers to become more accurate. So, the credit score formula applied today is not likely to be the same formula applied a decade ago. Plus, the credit reporting agencies, well, they generally have the same information, but they miss out on some of the smaller information that can impact scores, which is why people often have different numbers from each company. For example, credit scores may be affected whenever somebody requests a credit report. These are called hard and soft inquiries. That's right. If somebody even requests your credit score, it could bring your score down.
Oh, hell no!
That's how crazy all this math is. Soft inquiries don't affect your credit score because they aren't connected to any pursuit of debt. In other words, a lender conducting a soft inquiry isn't checking out your detailed credit report to determine whether they want to loan you money. The most common soft inquiry, or soft pull as they say in the business, is when you check your own credit. But it can also be checked by pre-approved credit cards or for background checks conducted by your employer. Hard inquiries do affect your credit score and are connected to some sort of loan or debt obligation. In other words, somebody's checking because they want to decide if they want to lend you money. And this can happen if you're taking out a mortgage, which is a house loan, or if they're trying to lease you a car, or if you're applying for a credit card, or you want some other new line of credit. So they're going to run a background check to see if you can be trusted. Now, the reason hard inquiries, or hard pulls, as the dweebs call it, the reason it affects your credit score is because it signals to lenders that you are looking for money. Now, one hard inquiry usually won't matter much. The impact it'll have will be relatively negligible. But if you're doing a lot of hard pulls, then that starts to add up because it suggests to lenders that you're trying to get funding from anywhere and everywhere that'll possibly have you, which suggests to them a lack of stability. In their eyes, it's the equivalent to running around the house looking for coins under your couch cushions. But someone who runs a hard inquiry doesn't need to check every agency. There's no requirement for a lender to call up all the agencies. A lender may decide to just call one and call it a day. Maybe they think that's fine enough. Maybe they'll only call TransUnion, for example. So TransUnion will have that hard inquiry on their report, but the other two may not, because they weren't privy to it. And those sorts of things can explain why the scores can differ a bit. They simply have different information. Most of the big information is there. Any missing information tends to be smaller. Thus, when you get your FICO or your Vantage Score reports, they're going to show you your rating for all three agencies, and may be different due to the information that they based their calculations on. So how do you interpret your credit score? Well, that's a good question. So let's talk about it. Your credit score will be placed on a scale. The range, including the FICO score, tend to run between 300 and 850. But regardless of which number you use, the rule remains relatively the same. The higher your number, the higher your credit score. The higher your credit score, the more reliable you are seen in the credit world. So the better your score, the more likely you are to be approved for loans. The higher the quality of credit cards you'll be offered. Additionally, the higher your credit score, the lower the interest rate you'll be charged for taking out loans. People with high credit scores are seen as low-risk borrowers. In other words, they're likely to pay back their loans. These are the customers that banks want to lend their money to because they're responsible. They pay off their debts. And thus, banks compete with each other to attract those customers, the ones with higher credit, usually by offering low interest rates. So maybe you're wondering what your credit score is right now. Can you check it? Well, yeah. As a matter of fact, in many countries, customers are entitled to at least one free credit report per year. So yeah, you could check your credit score. Heck, you could do it right now. You could just visit the website of your choice, whichever credit score you want, whichever one carries the most weight in your country, and look it up. You can get a detailed summary on your credit history, which is what your score is based on, by ordering a credit report through FICO, or you can order it through Vantage Score, or you can order it through any of the credit reporting agencies. Or if you live in America, you can simply go to freecreditreport.com and get all of them given to you right through that website alone. Of course, remember, different countries may use different credit reporting agencies and also have different rules about this. So double check which credit agencies run in your country and whether or not you're allowed to get a free credit report. These reports can be ordered online through each of the respective company's websites. So remember, you're usually allowed one free one per year. If you want more than that, you may have to pay for it. So 300 to 850, that's a pretty big range. I mean, generally speaking, what is a good score? Well, this table provides a general rule of thumb for determining where you want your credit score to be. The score of 750 or higher is going to bring about the best opportunities for a borrower. Although, depending on the lender, perhaps anything over 720 or even anything over 700 could be considered safe and may get you great opportunities. People who are considered to have bad credit will have a lot of trouble being approved for any loans, including credit cards, mortgages, car loans. I mean, it may be very difficult for them to get an apartment, since so many landlords do credit checks nowadays. Thus, why it's important to maintain a healthy credit score. So, make sure you pay your debts on time.
The easiest way to build your credit without taking on much risk is to make small purchases using your credit card and make sure to pay the balance off completely at the end of the month. And while it is true that you need to borrow money in order to build up your credit score, this should not be done irresponsibly. Borrowing money and spending on credit should not be taken lightly. And this is because far too many people fall into the trap of spending their entire life in debt. Yes, their entire life. And that can seriously affect your quality of living. So beware. Debt is not imaginary money. Eventually, everybody must pay the piper. And you should never doubt that sooner or later, he will come to collect.
I don't retreat, and I don't surrender. You've crossed the bottom line. Welcome to my world.